Is the market overpriced? We can all feel it is. But is there a signal, an indicator that tells you just by looking at the numbers? There is. This downside indicator is something that I keep in my back pocket, and you would want to as well. Let's jump in and take a look. And here it is. It's called the Shiller PE ratio, or specifically the S&P 500 Shiller price to earnings ratio. All it is it's the price of the overall stock market compared to its earnings for the past 10 years, adjusted for inflation. Also known as a CAPE ratio, doesn't matter. What does matter is looking at today's number. Today, it's sitting at 40.22. Now, historically, the average is 17.3. Anything above it means we are getting pricier and pricier. And the market at 40 compared to the historical average of 17.3 means we are extremely high. And you can see it's the second highest reading compared to the last 155 years. In the 30s, it crested at, let's see, right there, at 31 in the dot-com bubble, 44.19, and today we sit at 40.22, the second highest reading in the past 155 years. I repeat to emphasize we are at a tipping point historically of being the most overpriced in the S&P 500 in the past 155 years. Now I'm going to read you some numbers, quick numbers of these high readings and how it played out. August to September 1929, Great Depression. The Shiller PE topped at 30, and the Dow Jones Industrial Average would shed 89% of its value. July 1997 to August 2001. The PE ratio went all the way up to 44.19 in December 1999. The S&P 500 tumbled 49% of its value. NASDAQ Composite went straight down 78% of its value. September 2017 to November 2018. The Shiller PE surpassed 30 once again, and S&P 500 lost 20% during that time. December 2019 to February 2020 during COVID, the Shiller PE ratio went up to 30 and S&P 500 lost 33% in just a month. August 2020 to May 2022. In the first week of January 2022, Shiller PE touched 40 before the bear market kicked in. And then November 2023 to present. That's where we're at right now. This is the sixth time that the Shiller PE is over 30. Now, the Shiller PE ratio doesn't tell you when exactly the market would downturn. It just points to that this is not sustainable and eventually a downturn is inevitable. Clearly, during the dot-com bubble, for 4 years, we had a high Shiller PE ratio, but eventually, the markets tumbled, shedding 50 to 80% of its value. The key takeaway is to be aware of your surroundings. Be aware of the bigger market trends and where we sit historically. That way, it can help you be better prepared to make smarter decisions in your future trades and investments. And eventually, once the market goes down and we're in a bear market, how do we know when it's the right time to buy? When the market bottoms out? I had talked about that in my previous video. There is one other indicator that I keep in mind along with the Shiller PE ratio. Shiller PE ratio will point to eventually the market's going down. And once it does, when does it bottom out? When do you have a clear signal on that? I had talked about that in my previous video. Check the link in the description down below if you want to go deeper with that. If you found today's video helpful, please be sure to subscribe, and I'll be happy to share more tips and insights in future videos. Thank you for watching, and I will see you in the next upcoming video.